Welcome again, ladies and gentlemen, to Rogue Economics. I'm your professor, Rogue Professor Sanford Khan. This is Rogue Economics, lesson number 23, entitled What Could Cause the Stock Market to Crash? I'm also a business author and business speaker. There's two things that could cause it to crash that I see. Of course, there's always the unknown. Actually, let me think. There is a third thing that could cause it to crash that really no one's mentioned about. And it's actually happened when Obama was president. But let's go into the first two major things that could cause the stock market to crash. The first one, inflation takes hold of the economy and becomes stubborn. It doesn't become transient like Jerome Powell, head of the Federal Reserve, thinks. It goes up and then Jerome Powell say, well, it's going to come on back down. It's just transitory, folks. That's his thinking. It may not be. We're flooding the economy with billions, actually wrong, trillions of dollars of stimulus money. Trillions. It's hard to imagine it, but that's the case. Meanwhile, productivity is not increasing at the same rate that you're flooding the economy with money. The simple definition of inflation is too much money, credit, chasing too few goods and services being produced. So you're flooding the economy with much more credit, money, than goods and services that are being produced. Guess what? Inflation may stay around for a while, not at 10, 12%, but at 5 or 6%. The Fed will then be forced to cut back on its bond buying program and raise interest rates, short-term interest rates. That would definitely crash the market. That would crash it, because the market is built on one thing right now: easy money and cheap money. Another thing, the second thing that could do it, are massive tax increases that the Biden administration is proposing. Please understand this. When you raise taxes, that puts downward pressure on the economy. You're sucking liquidity out of the economy. You're taking it from productive hands to unproductive hands, transfer payments, whatever. 70% of the U.S. budget is transfer payments. Very few of the budget goes for defense. A very small percent goes to defense. When you do this, when you suck liquidity out, guess what? That puts, again, downward pressure on the economy. And we're talking about raising tax. He uses the term the so-called rich. I could argue that the taxes, any taxes on the rich, will eventually filter down to the middle class, because the rich does most of the spending. I'll give you an example. This really doesn't have to do too much with this video, but the top 25%, the top 20% of wage earners, income earners in the United States account for 45% of retail spending. Retail spending makes almost 70% of the economy. Almost 70% of the economy. They say 2/3, actually it's closer to 70%. Doesn't matter, it's big enough. It's over 50%. So if you suck liquidity out of those who have done well and spend the money, they cut back. They hire less people. Companies hire less people, less investment. People don't spend as much as they used to. They still spend, but not as much. Guess what? The economy suffers. That will crash the market. And that has crashed it before. That has definitely crashed it before. You raise taxes. There was a president that I didn't usually agree with of the United States economically. But he said something that I do agree with. And he said this. He says, you don't raise taxes when the economy is soft. You know who that president was? I didn't vote for him, but he was right. That was President Obama. The economy is doing well now because of all the stimulus, but it's going to cool down. This is just an adrenaline rush. It will cool down. You raise taxes, it'll cool down real fast, real fast. The market will reflect this before the economy cools down, usually 6 to 9 months before. This will crash the market. There is a third thing no one has mentioned that I've seen. We're running trillion-dollar budget deficits as far as the eye could see. And if the President Biden gets his American Family First plan, another several trillion dollars that he wants to spend, actually more than several, I think it's $6 trillion or so. The deficits are going to continue forever in the trillions, not 1 trillion, but in the trillions. Guess what? The market can't absorb all this government debt. The 3 rating agencies, that would be Moody, Standard & Poor's, and Fitch, they will downgrade U.S. government debt. They did it during the Obama administration. We went from AAA to AA+. We will take another hit on our ratings because you can't keep going this way. Eventually they'll say this is unsustainable. They'll be forced to downgrade the rating. What do you think that's going to do to interest rates? More risk on government debt. Investors will demand a higher rate return, interest rates. Look, I was watching a video recently. It was by Harry Dent, and he went on a rant. It was very recent. And he said this stock market's going to top out between now and the end of the year. Excuse me. January the latest, January of 2022. I don't know if he's right or wrong. I don't know. But I know this market is going to top out because it's through the stratosphere. I look at the Buffett indicator. That's a ratio of total market capitalization to GDP. It's beyond Mars. It's the highest in history. The highest in history. It's not in the stratosphere. Like I said, it's beyond Mars. Anything that goes wrong is going to burst this bubble. This is a bubble. We'll burst it. One thing I don't know if he's right. It's going to top out between now and the end of the year, maybe January the latest. I don't know. But I agree with him one thing. He said when it does top out, it's going to go down fast. Why? I agree with him on that. Why? Very simple. Margin debt, money people borrow to buy stocks, is at its highest in history. Once the market starts to go down, there's going to be margin calls right and left. Then it'll go down more. They'll be selling, forced selling. Once you get into that, you're going to get into cascading type of fall, where more and more people will be forced to sell because more debt margin calls will go out and they'll start to sell stocks. The good companies along with the bad companies will be hit. So I agree with them. Once this market starts to go down, it's going to go down big time. And I don't know when it's going to happen, but I think it's sooner than later. The game is coming to an end. So therefore, if you're in the stock market, and I am, start taking defensive positions. Maybe raise a little cash. Take some chips off the table. I've done it too. Or if you want to stay in the game, which I am also, go to defensive stocks, utilities, food companies. You know, people are still going to eat granola, Rice Krispies, Quaker Oats. I'm not recommending these companies. I'm just saying no matter what happens, people are still going to eat. These companies will probably go down in value, but they are the basic type companies. People in the food, utilities, water. You know, people will still need this and they'll buy this. May not take as many vacations, but they will. Anyways, I'd like to encourage you 2 things. My book, I try to remember to post. It's called a Rogue Meister's Guide to Free Thinking. What I talk about on these videos is contained in this book. It's available on Amazon in both ebook and paperback. The other thing is, please pass this video on to other people. And actually a third thing, please subscribe to my channel. I would really appreciate it, ladies and gentlemen. If you could subscribe, hit that red button down there, and subscribe to my channel. Until we meet again, stay prosperous, and be healthy. Bye now.